Hey guys, what's up? Stock Retail coming back to you. Check out this sweet graphic that came out today for Kong Godzilla. Saw this on, I still call it Twitter, if you want to call it X, whatever. A few accounts were kind of posting it. Man, I love this one. Gets me kind of fired up. I'm looking forward to the movie, and these graphics are just awesome. I think this movie even comes out right around or maybe even on my birthday, so I got to double check the dates on that. That would be a pretty fun gift to me. Gonna do pretty well, I think, this movie and add a lot of value to the company. Speaking of value, I got asked about AMC valuation quite a few times in the last week or so. So I just want to talk about some ways you can look at that. I'm not going to give you any hard answers on what AMC's value is, but I'm going to give you some ways to look at it. And I will give you some, a little bit of math on potentially, basically scenario math, let's call it that. So let's just dive in. First of all, here is just a view. You can kind of go Google and find sort of AMC's price to earnings over the years. Obviously, it's a very different business now than I'm showing you here in 2014 through like 2018, maybe through 2017. But you can see all through kind of 2014, 15, 16, 17, the price to earnings ratio kind of hovered in the mid 20s. I'm showing you the far left here, the end of 2014, which is roughly the high point. You can see also then towards the end of, I think, 2017 there on the right, kind of came back to that. So just call it kind of 20 to 25 range, mid 20s price to earnings ratio back then. Now the business is quite a bit different, although, I've shown you, if you watch some other videos, if you look through AMC's income statements and go through every item in the expense side and the earnings side, there's a lot that is actually better now than pre-COVID. I've kind of demonstrated that in some other videos, and I'll just give you a couple examples. Like rent is actually lower now. Believe it or not, debt is lower, and I believe will be a lot lower soon as we pay that, further down. And so there's other kind of elements in the expenses that are actually better now than pre-COVID. And as movies come back, my thesis has always been that even aside from a squeeze play, this becomes a fundamental play. Now, the reason I highlight that, people used to try to say, oh, you talk so much about fundamentals, I'm here for a squeeze. I don't get that one so much anymore because I think people realized they weren't going to be able to derail me. And I don't think those were good apes who were kind of sending me those messages. Side note, I get a lot of different messages trying to get me to shut up, and have through the years. And I don't know, Shorty, if you're listening, that's just not going to work. It usually actually just makes me double down and get more stubborn. So try a different angle. Anyway, the reason I look at fundamentals is it's like, hey, if we already know we're going to win just based on the numbers, the last video I did, I said, hey, the numbers tell a story. If even just based on the numbers, we see that the stock is worth a whole lot more than it is now, then it becomes a kind of a not a very risky investment. And then if on top of that, we've got a shot at a short squeeze on something that's not really, that much of a gamble in terms of fundamental value, that's something that was really attractive to me all the way back in 2021, and one of the reasons I've been here the whole time. And so far the thesis is held, right? Like my whole thesis was they're not going bankrupt, and I can see in the financials that they're going to turn this thing around and actually become even more profitable. So I just want to kind of lay the groundwork that yes, this is a long time ago, yes, this was a different business, but that actually in some ways it's a healthier business now than it was then, and might even deserve a better valuation than this. But let's just kind of ground ourselves in, hey, it's been here before, may get here again. Then I want to just show you, and you can, again, go Google this. Let's actually pause and talk about two metrics I'm going to show you. So I'm going to show you price to earnings, which I just talked about a minute ago, and I'm going to show you price to sales. So let's kind of define those two. So price to earnings is take the entire year's worth of earnings for a company, divide it by how many shares there are, so that's your share price. But actually what happens is there's a price to earnings ratio on anything out there. I did a whole video on this once too, and you could see, like, take the S&P 500 as an example. You're going to see over, say, the last, 50 or even 80 years, there's usually something a little north or around 20 as a price to earnings overall for the S&P 500. Now, lately over the last few years, we've been way, way above that. So that's why some people, kind of might talk about an asset bubble, an equities bubble, a stock bubble. Valuations have been a lot higher. On the other hand, there's also been a lot of growth out there. It's a time of inflation. There's a lot of different reasons. And actually, inflation would kind of push you the other way, but we got to have a whole conversation on the time value of money at some point for that. And I'm not going to do that today. But the point is, across the S&P 500, so a really broad basket of stocks, you'd see something north of 20 as a price to earnings ratio. Now that means that you're putting 20 years worth of earnings into today's price of the stock. If you go look at like Amazon historically, it's been more like 100 plus years of earnings into the stock. A while back, I think it was like a year plus ago, you can go find a tweet where I said, "Hey, I wouldn't be buying Disney right now as a stock." Someone was out there being bullish, and I said, "No, I wouldn't buy Disney." It had like, I don't know, 75 years of earnings priced into it at the time, and I was like, "That's not going to work, especially as inflation increases and all of that." Well, sure enough, since then, like Disney's come way down. So it's just kind of a quick example to say there's kind of a way you can look at a value of a stock and say, do I think this is worth buying right now or not? Do I think it can go up? Are they bringing in the business to justify the price of this stock? So price to earnings is just a really historic way, kind of a tried and true, been used for a very, very long time as a way to look at stocks. So I'm showing you here. You can Google this. The thing is, you want to look at different industries. So you're not going to compare AMC's price to earnings to, say, a software company who's maybe growing really fast. Then we get into a whole conversation about something called a PEG ratio as well, which is price to earnings over growth. I'm not going to show that today, but that's probably worth a follow-up. So I'm going to show you here a view of industries, and you can kind of see I've just gone and grabbed 3 industries that are probably of interest to us. So and you can see this website, EQ Vista. There's plenty of other websites you can find. This was just one of the first that came back on a Google search. So you can see the entertainment industry has roughly a 30 price to earnings ratio. Now that feels a little high to me. So in a minute here, as we go through AMC, we're going to use a lower number than that. But just so you can see out there in the industry. But of course, entertainment, that's a wide bucket. That's not just movie theaters. So that's probably why it's a little high. There's probably some other types of businesses in there. And then restaurants, you can see, because AMC is also a food service provider, and in some cases even has, kind of a bar and a restaurant. So restaurants looks like it's about a 28. So we're kind of in that same zone, 28 to 30 in restaurants and entertainment. For those of you who love Hycroft, I brought in metals and mining here. So you can see about 18 and a half as a price to earnings. So that might be interesting. We can kind of go look at Hycroft someday. So that's just kind of on price to earnings. Now let's look at price to sales, because we're going to look at both of these. I've got an entire video you could go find on price to sales. I had done that quite a while ago when I was feeling like we were, the stock price was too low. And so I was looking at basically, is AMC going to become a value play? So we're just digging back in on that again today. So if you want to really go deep on price to sales, I've got a whole video on that. You can go find that. Otherwise, I'll just cover it now real quick. So it's much like the price to earnings ratio, but what'll happen is if you don't actually have positive yearly earnings, like a full year positive earnings, the price to earnings ratio becomes something you can't really use. It turns into a negative number and it just doesn't really work for your stock. There's sort of a historical thinking that if you're in maybe let's say an up and coming startup that hasn't hit profits yet, like think Tesla, a few years ago, before Tesla hit profits, some people looked at it and said, hey, actually, there's value in this company. And so one way you can price a stock in a company that's not yet earning positive earnings is to look at their sales and have a multiple of sales as the stock price. So that's price to sales, where you take the year's worth of sales, much like we did on price to earnings, take a whole year, divide it by how many shares there are, and then multiply it by some multiple of years. So in this case, what you can see is in movies and entertainment, there's kind of a historical price to sales ratio of 3.68. Now, what you're going to want to understand there is that's probably a mix of studios and theaters. Although great to see that actually AMC now, has some distribution, right? We're not just an exhibitor, we're a distributor now too. And then you can see restaurants a little higher, and there at the bottom again is metals and minerals at actually quite a bit higher there. Probably sales are a little bit lower, and maybe there's some value in the sales. You'll see again by industry, if you went to that website, you're going to see a whole bunch of industries. Like the tech industry is far higher on price to sales. Probably just, more profitable. Like $1 of sales in one industry might be worth more than $1 of sales in another industry because of your expenses. Another reason people use price to sales, which is going to sound like AMC exactly, is in turnaround stories, where maybe a company has hit some headwinds, some speed bumps, but seems to be turning around and going more positive, hasn't hit positive earnings yet. Price to sales is a way of valuing that company. So it's kind of a perfect metric for AMC. So we're going to go through that. Next thing, if you're new here, I'm not going to go deep at all on this, for the sake of my kind of listeners who've been around for a while. But just to kind of establish, I have been forecasting AMC's, really all of AMC's numbers. I go through every line on the income and expense statements, and I forecast all of them. I've also been forecasting the box office, and I've got, I don't know, 10 quarters plus now, a couple of years worth of being pretty darn accurate with that. So that's why I've been starting to feel comfortable share that with you guys. But if you want some credibility, go find some of my past receipts. You'll see, for example, I told people a year before it happened that Q2 and Q3 of this year were going to be profitable. And sure enough, we were. So if I've been able to call the shot that many times, I've established just sort of a track record of getting things, as far as a forecast, being pretty accurate. One of the things you'll often hear from me is just kind of a saying in forecasting is if you have a forecast, it's wrong. So, while I'm kind of, I don't know, bragging a little bit about getting some things right, I hope you hear the context that getting it right in forecasting, that comes in context. And so I don't mean that I'm literally getting it 100% right. You can't take any numbers I'm going to show you as this is literally going to happen. But you can say, okay, directionally, he's been right quite a bit. So there's a decent chance he's kind of right in terms of the overall direction of what's happening. Now, granted, a lot of things can happen that I don't know about yet. Adam has shown a willingness to innovate. His executive team has shown a willingness to innovate and seek opportunities. So they may find opportunities that I have not yet forecast. I think that'd be fantastic. So what I'm showing you here is kind of through 2023. This should be reasonably actualized, I'll call it. It's kind of a term in forecasting as well. So 2021 and 2022, those are completely actuals. Those are the numbers you can go find in the earnings reports, and you can fact check me on those. 2023, as you know, we've had 3 of the 4 quarters have gotten reported, and then I'm forecasting the 4th quarter. So 3 out of the 4 are actuals, and then however accurate I am on the 4th quarter. So I ought to be close. And then 2024, I shared a whole forecast video on that. You can go back and find my forecast video. I think that's 2 videos ago. Excuse me, a little frog in my throat. And then 2025, I also had shared that, and actually 2026. So those should not be new if you've seen that video. And then today, I just took it out through 2027 because I want to talk about where might the stock be going on a fundamentals perspective. So what you can really see, and I said this in the forecast video, is it's really at the end of 2024 now. Would have been, frankly, we would already be there now in terms of profitability. But the darn strike started pushing things out. Like this 4th quarter that we're in now, Dune and Ghostbusters and Craven and a couple other movies pushed out. Otherwise, I think we would have had profits again this quarter. So in terms of AMC's ability to deliver profits on a still lower level of movies than pre-COVID, it's already been demonstrated, right? We just did the last 2 quarters on half the movies that we had, in kind of the same periods in 2019. So it's just really, really obvious. And I think at this point, I don't even have to prove to you why I'm right, that with the addition of popcorn and Zoom meetings and candy and potentially wine and beer and now distribution and concert movies and all of that, as Hollywood gets its act together, no pun intended, and starts having more movies, even at like 2/3 of the movies of, say, 2019 level, AMC is going to be really, really profitable. It's just kind of already proven. We hit profits on basically half the movies of 2019. What do you think happens as we get more movies and as popcorn grows, distribution grows, candy, beer, and wine potentially grow? Let me go back even. When I say we're not the same company we used to be, that's what I'm trying to say is actually we're frankly even a better company now than then. And yes, we got to deal with the debt. I've shown that in other videos as well. You can go find that. Look at the Q3 earnings review where I actually go a little bit deep dive on the debt. So just for anybody out there, understand that I am acknowledging that. In fact, this view here is showing you bottom line earnings. So by year, this is what I believe will be sort of the profit and loss reported, the bottom line. And that's after paying debt. So in 2025, you can see that's when I believe we get back to positive earnings. Oh, I was starting to say, and I kind of derailed myself, Q4 of 2024, I see very positive earnings. Actually, that'll be by far like our biggest quarter yet. But we kind of now, because of the strike, hit that little sort of, I don't know, delay. The next few quarters are not as great as that. And that's just what we're going to have to deal with. But you can even see, look at 2024, even though I'm kind of lamenting the strike and it sort of delaying our profits, it's still better than 2023. We're still going the right direction. And, we're sitting on $1 billion of cash, as far as we understand, from the latest stock sale. So the cash is there, our ability to weather this sort of little blip, this delay from the strike, and then get back to profits, it's coming. So that's why I want to start turning my eyes to, okay, so what is the stock worth if these earnings start to materialize? Before we go there, one last view. So what's driving those earnings is also our sales. So remember I said I'm going to look at a price to earnings. That's the last slide before. And I'll look at a price to sales. So you can see, I don't know, screenshot this, look at this later, pause this if you want. These are my revenue forecasts that include assumptions around popcorn and candy and beer and wine and distribution, all of that stuff. Okay? So we're going to look at price to earnings, price to sales. I guess what I'm really saying without going super deep is, if you've been around for a while, you followed me for a while, then you already know my level of accuracy. If you're new here, go back and look at some receipts. I'll stand by what I've said because the scoreboard is there for me. So I'm going to just kind of say, hey, there's a decent chance I'm at least close on these. Of course, as we go out farther in terms of years, there's a whole lot that's going to happen between now and then in the entire world and in our company, right? So that's why the farther out we go, the more I'm starting to make a lot of assumptions. All right, so let's actually get to this. So stock price valuations. I showed you that the price to sales ratio in our industry is 3.68. So I'm just going to go ahead and use that. By the way, the current price to sales ratio for AMC, which you can see, is 0.22. Very, very low, right? And that fits. A lot of us believe our stock price is extremely depressed. Well, I mean, that's, I don't know, what is that, like 15, 16 times below kind of a historical industry average. So that right there tells you the story. I mean, if you want to tell your friends about stock price manipulation, just use that right there. Our price to earnings ratio, I'm going to use 24 here. So I showed you that back in at the end of 2014, and I'm telling you that our fundamentals are actually stronger now than then. We were at a 25. Now I'm going to use a 24. So that feels pretty reasonable. What I want to say before I kind of go through these things, we saw like recently the passing of Charlie Munger, from Berkshire Hathaway. Their whole thing, Warren Buffett and Charlie, their whole thing was kind of this idea of a 5-year hold. If you believe in the future of a company and you believe, they would often look for like value plays. If you believe in the value of a company and you believe perhaps the stock is not reflecting the company's future performance, maybe even present performance, then that might be a stock you buy. And there's this idea of contrarian investing too, like buying at a time when no one else is really buying that stock. Obviously with AMC, there's a ton of people buying the stock. That's a kind of a different story. But in terms of the price, it's not real pretty, right? So buying a stock that maybe doesn't look pretty, but the company's performing or you believe in its future performance, and you hold that for a while, there's this idea that, today's stock price, there's a lot that can happen, but over time, the fundamentals of a company are kind of like gravity. Something can't, you throw a ball in the air, it's going to come back down. Gravity just has a way of doing its work, right? And so I believe that about AMC. It's a reason I've been able to stick around so long. And, as annoyed and frustrated as I am along with all of you at stock price manipulation, I do believe sort of in the fundamental laws of finance that over time we're going to win. We just are. So have that idea of kind of a longer term hold in your mind and think through, if you were to invest today in a stock for 1, 2, 3, 4 years from now, what kind of returns would you hope to get? And so let's go through this with that in mind. So right now, if AMC was at a 3.7, let's call it price to sales ratio, this 3.68, it would need to be at $74.50. By the way, what I'm using in terms of our shares, I'm assuming that $350 million share sale that Adam announced at the earnings call. So I just said, all right, let's say he averaged out to something kind of between $8 and $9, and I'm adding those shares to our current float. So I'm already using a higher float than what's out there. So I'm taking the 198 million shares and I'm adding the sale for those $350 million. So at a more diluted share count, we still need to be at 74.50, which is 11x, 1120% what we are right now, just on a standard historical price to sales ratio. All right, so if we were to go out and use my sales projections, In 2024, then we need to be at 74.70. So you saw, let me go back on that one. And I talked that through in the whole forecast video. Remember, I said we've got the blip from the strike. We're basically flat on revenues next year, although that is on less movies. So I was also praising Adam because I said, look, if you think about distribution of the concerts and perhaps, like comedy events and stuff, and if you think about popcorn and now selling candy, Adam has actually allowed us to just slightly grow revenues is what I'm forecasting, but that's actually on a smaller box office. So you can go back and see the forecast video if you want to get more detail on that. But that's why you see this relatively flat number in 2024. But again, that's 11x our current stock price. And then in 2025, we start really ramping up as the movie industry recovers, and as now I'm going to assume some growth in all of those areas, distribution, popcorn, etc. Now we're at a 14x. We should be at $93 with this price to sales ratio. And then we start really cooking. In 2026, we should be 15x what we are now at $103. In 2027, 16x what we are now at $109. Again, this is strictly fundamentals. I'm not even talking about a short squeeze or any kind of hopium. I'm using industry standard ratios and my sales forecast, which has historically been accurate. So let's hope that I can be accurate again. This is just math here. This is what the stock price in general should be if you were a value investor. All right, so let's look at a price to earnings ratio of 24. Now, the first 2 years, you're not going to see anything. And I mentioned that's because I don't believe we're at positive full year earnings this year or next year. So let's look when we start having positive full year earnings in 2025. Then the price to earnings ratio of 24 would get you a stock price of $41. So even if people said, I'm just going to stay away from AMC until it's, turns positive, you'd still be looking at 6xing. Let's say you bought a share today, then by the end of 2025, it ought to be 6x just on a old school price to earnings ratio. And that's not even thinking about the growth rate that AMC would have at that point. It's going to be growing by leaps and bounds. And so usually if a company is growing, people are willing to give it a much higher price to earnings ratio, which is why I said at some point we need to talk about a PEG ratio, which is price to earnings over growth. That's another way to look at it. So what I would suggest is this $41 I'm showing you in 2025 would still be probably way too low. If I have buying power that year, I'd be looking at that going, hey, I still want more. 2026, then you can see at a price to earnings ratio of 24, we'd get to $76. So there's your 11x. I just got to hold the stock for a few years and 11x my money. In 2027, then you kind of start evening out between the price to sales and the price to earnings. And that's because I've shown you AMC has a heavy fixed cost model. So there's a lot of costs in AMC's business model that are what's called fixed costs. They don't go up as fast as the business grows. So you've got something called variable costs and you got something called fixed costs. So in general, like if you're paying your rent on a building, whether you show one movie or 100 movies, obviously it's a whole lot better if you get to show 100 movies. But your rent didn't really go up whether you showed that one or the 100 movies. And so that's a fixed cost where your revenue is going up faster than your costs are. And so because of that, that's why you see in the out years, the price to earnings ratio starts to catch us up on the stock. But so the main point here, you can just see we're, by any fundamental analysis, we're way, way undervalued. And just think through too, any and all short sale covering is effectively going to be some kind of addition or even I would say a multiplier to these numbers. Okay, so I just showed you a view without any short sale covering. And sorry guys, there's some leaf blower or something in my neighbor outside. I'm just going to push through. So I'm showing you a view without any short sale covering, just fundamental analysis that says, you should be 15, 16x on the stock in like 4 years. Now what do you think starts to happen as the business does not go bankrupt, as it starts getting healthy, as it becomes more and more and more obvious to the general public that the shorts are lying about this business? Add short covering on top of whatever you see here. That makes me extremely bullish. Now I just want to show you a view of another company. Here's a company I'm showing you 2019 on the left. You can see September 30, 2019, and then September 30, 2023. So over these 4 years, this company went up, I don't know, actually here, let's just flash this up. So Tesla went up 16 times in terms of the stock price in 4 years on only increasing the sales 3 times. And you can see this price to sales ratio. So at the bottom left, Tesla was a 1.7. Back in 2019, it was heavily shorted, right? Similar story. Now it's at a price to sales ratio of 9. So the price to sales went up, let's call that, 5-ish times, a little over that, while the stock price went up 16 times. So heavily shorted company, perhaps not reflecting its value. Sales are projected to grow significantly. And what I would say with AMC is because of its fixed cost model, Tesla is going to also have a lot of variable costs. As you ramp up production, there's a cost to that. Whereas with AMC, like I said, if you have a building and you show one movie or you show 100 movies, there's not necessarily an increased cost on some of the items. It does cost more to have more workers. It does cost more perhaps to keep the lights on a little longer. There are variable costs in AMC's model, and I account for all of that. But the point is, our earnings are going to ramp up a lot faster than our revenue. And I've shown you that, over the past couple of years too. So this is just an example of what can happen. In 4 years, they only grew their sales 3 times, but the stock grew 16 times. Well, I would suggest part of that also is short covering. Tesla is kind of known as almost like an infinity squeeze. If you really look through the history of Tesla and you account for various splits that they've had, I believe the price got to something like 6,500. So don't tell me, that AMC can't do it when, one, there's roughly, 22 million shares short right now, 21-ish, something like that. I didn't look today, but it's somewhere around, let's say, 20 to 22 million shares, which is close to about 180, 190-ish million pre-split. Now, you got to remember we have dilution and all that since then, so that's why I'm not just doing 10x. Then on top of that, if we have any hidden FTDs, swaps, derivatives, cross assets, backing up naked shorts, I got a feeling AMC could really run. And that's why I'm saying if even just the fundamentals say it's going to like 15x, now add any short covering on top of that. Look, I want this to happen tomorrow. And I actually believe there's a chance we're in the middle of something that we could start seeing soon. I honestly believe that. I'm not going to give hopium. I'm not going to give a price or a date. I never do that on my channel. By the way, there's a friend who kind of laughs because I always say this channel. And he finally kind of asked me like, dude, do you have another channel? Why do you always say this channel? I don't know why I always said that. So I'm trying to start saying my channel. So if you listen to this, you know who you are. That one's for you. But anyway, here on my channel, I don't give dates, I don't give prices, so I'm not going to say much about the fact that I think we could see moves soon. I've left some breadcrumbs for that in a few videos recently, but, no one ever knows, right? No one ever knows when we're going to actually run. But my point is, the fundamentals point to a run. Good luck, Shorty. Good luck. All right, a couple other things I'm watching, and then we're almost done here. Just a couple items of note. So on the left, you see just some updates on crypto spot ETFs. This one's Grayscale. Excuse me. Sorry, the one on the right is Grayscale. The one on the left is around some SEC rules, but both are around spot ETFs. That's something, here's another breadcrumb. I've said to be watching that. Watch the development of these spot crypto ETFs. I believe that, I'll drop even another hint on the breadcrumbs. I actually believe that has a little bit to do with all of the naked shorts and the FTDs and where some things got hidden, where some bodies are buried, and actually even related to Ape and some other things that have happened, and Binance and FTX, all of it. I believe it's all wrapped up. I believe it's all related. I will, slowly try to feed out some DD on that. Some of it I've even confessed that, hey, I only understand it at a very complicated level. I want to be able to explain it simply, which means I don't even have a full grasp on it yet. There are things that I kind of understand but need to study more. So until I can kind of explain that clearly and simply, I'm just dropping breadcrumbs. But keep watching the spot ETFs for crypto. I believe that's a big deal. I mentioned in terms of the timeline, those got really ramped up. You could see basically everybody started scurrying when Ape converted. And so that's partly why I believe it's related as well. Then on the right, so it's just interesting language here. So Grayscale updated their agreement for the first time since 2018, blah, 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 blah. But look at this language here. Allowing assets to be mixed in omnibus accounts to facilitate stocks creation and redemption. Boy, my eyes bulged when I saw that word redemption. I need to do some more DD, but I will just say redemption. If you could see me, I'm kind of smiling over here. I like that word. I think that could mean some good things for us. If I've been right about tokens, if I've been right about Binance and FTX, and so far, frankly, it looks like I've been right. There's been a lot of smoke where I've said that there's a fire. Um, then perhaps I'm right about this redemption thing, and I think it could be really, really good for us. But we're going to have to wait and find out. I can't make a promise on that. All right. Summary. Eventually, even from a fundamental valuation, if you're buying this stock today, obviously not financial advice. Gosh, that's such a cliche. We all say that. I'm not a financial advisor. I'm kind of an operations and supply chain and forecasting guy, finance as well. But my point of view, this person's opinion, is you're looking at like a 15 to 20 bagger at even a conservative view over the next like 4 years. I gotta scrape together every dime I can and find a way to get it into this thing. That's just my point of view. You don't have to follow me. I'm not pushing that on anybody. I still believe in the squeeze. Just let me say that super clearly. I want apes to keep watching those cross assets. We're going to keep learning about that topic together. I want you to understand that topic. It's going to become important. And I like the stock. So let's go.